In this video, I discuss 7 financial moves you should make right now if you're retiring soon. Coming up next on Holy Schmidt.
Holy Schmidt!
Retirement is a great time of reflection. It's a time where you look back at your life and marvel at all that you've accomplished. It also is a time of concern for what lies ahead and the moves you need to make in what lies ahead because it's all new to you. This video will cover off 7 things that you need to do ASAP if you're retiring soon. Now let's get into it. But before we do, please make sure you click the like button. YouTube uses the number of likes in its algorithm, and I want to help as many people as possible. All right, let's go. Point number 1 is get an estimate of your Social Security payment. Let me begin by saying if you have no idea what your Social Security payment looks like or what it's going to look like in retirement, now would be a really good time to go to the SSA website and check it out. You'll want to do this both for yourself and if you're married for your spouse, both with a spousal benefit and his or her full retirement benefit on their own account. You never want to walk into any situation, your retirement or personal really, where you don't have a reasonably good understanding of what the outcome is going to be before you walk in. Checking your Social Security retirement benefit will allow you to have a much better understanding of where you might be in the future. Also, and really importantly, check to see what it looks like on day 1 and if you decide to wait to draw down on Social Security for a year or 2 or more. And very importantly, understand the difference between the spousal benefit and what your spouse receives on his or her own account. We'll talk more about this near the end of the video. I also have a very popular video on spousal benefits. I'll put a link in the description below for you to review at your leisure. Point 2 is understand your new tax pattern. Up until now, you've probably had taxes withheld from your paycheck, and those taxes, more or less, were enough to cover your tax liability at the end of the year. But in retirement, many times you're responsible for your own taxes. A good example is if you have a traditional 401k. When you draw down from the 401k, it's a taxable event, and you owe tax on the money you've taken out of your 401k. Other retirement vehicles like a Roth IRA or 401k provide you with the funds free of tax, but they go in with after-tax dollars. Another account, like an HSA account, is a tax-free account both going in and coming out. You pay tax-free dollars into your HSA account, and when you withdraw the funds and the growth, and you pay no taxes on either the funds or the growth. Finally, something like rental real estate offers big tax deductions on both the real estate and also sometimes your primary income and positive cash flow as the cash comes out of the investment to you. And by the way, people don't have most of those in combination. They'll have 1 or 2 or maybe 3 if they've planned way ahead. So don't worry about it if some of that stuff just doesn't sound like something you've ever heard of or at least have had access to. But the important thing is know what you have and what the tax liabilities are on what you have. Point 3, understand your financial station as you enter retirement. Now, what do I mean by that? Believe it or not, many people enter retirement not knowing what the road ahead would look like. At a bare minimum, you should know what your cash flow looks like. I just talked about your Social Security benefits and your taxes, but you should also know what your cash flow looks like with any savings, assets, pensions, etc. that you may have. Take your funds from savings and investments and break those down into a monthly number. Use the 4% rule, meaning you take 1/25 of the value of the assets and use that as your annual revenue number that you can withdraw from the assets and divide that by 12. That becomes your monthly number. Of course, everybody uses a different rule. That's one of the more common ones. Also, are you going to work part-time? Do you have any additional cash flow coming in outside of your assets and Social Security? Do you have a pension? Do you have dividend stocks, municipal bonds, or interest-paying bonds of some sort? Knowing what you have and how it breaks down into a monthly income stream is really, really important for you to plan the road ahead. Point 4 is time management, planning your time. This is a big one, primarily because people don't think it's a big one until the reality hits them that they have nothing to do. You've worked for 30 or 40 years, day in and day out, almost every minute was planned, whether it was getting ready to go to work, going to work, working, coming home from work, spending time with the family after work, etc. Now, all of those obligations, or most of those obligations, are gone. Are you married? Is your spouse working? If not, are there things that you can now do together? If he or she is working, what will you do during the day? Many people answer that question with whatever I want, which is absolutely fine, of course. But remember that once you get past the point where you've done nothing for a considerable amount of time, you're going to start to get bored. Still, many people will spend the next part of their lives doing very little and enjoying it. If you're one of those people, disregard what I just said. If not, you need to get a plan together and at least know what you're going to do for big parts of your day. Point 5, eliminate credit card debt. Demolish it. Get rid of it. Super important here. Getting your debt balance down to zero is job one in retirement. And job one of job one is getting your credit card balance down to zero as soon as possible. Credit cards are expensive. They're 18, 19, 20, 25%. Some cards are 24.99% and higher. Credit cards also use cash flow to pay that high interest. And if your credit card debt is paid off, you can use that cash flow somewhere else. There are also the non-financial elements of credit card debt. Credit cards weigh heavily on your mind, more than any other type of debt, because there's no perceived benefit to that debt once it's on your card. It's not like a mortgage, where you feel like you're getting something every time you make a mortgage payment. Most people don't feel great when they make an interest payment on their credit card. Also, credit card rates can go up even if you've got good credit. And in this environment, we're in an inflationary environment and credit card rates are already very high, it's likely they'll go up at some point. And if you have a choppy payment history or your credit report changes for the worse, your credit card payment could go up then as well. Point 6, check your health insurance. This one is easy to do, but also easy to miss. And in either case, it could be very expensive unless you plan accordingly. Health insurance is something that is nearly invisible to most people. This is because health insurance is usually provided by an employer who either covers most or all of the costs themselves, or if they don't, the cost comes out of your paycheck before payday, therefore you don't really see it. But in retirement, if you're not 65 and on Medicare, you will definitely see it. You'll definitely have to write the check, and it's something you need to plan to do because you can't go without health insurance into retirement. And of course, when you enter retirement, if you're under 65, you'll have options: COBRA, an individual plan, etc. But spend a lot of time understanding this point. Most people have pre-existing conditions by the time they're in their 50s and 60s, and this is something that will affect either the cost of your insurance or the validity of your insurance because of pre-existing conditions. The last point, understand the Social Security spousal benefit. This one's really important because Social Security spousal benefits are fairly complex. The rules are different for a spousal benefit than they are for the primary insured, for example. If you wait to draw down on the spousal benefit, it grows at a different rate than on the PIA, the primary insured's amount. And also really important, the spousal benefit does not grow beyond full retirement age. Once you hit the FRA, you don't have the added benefit that you have if you're the primary insured on waiting until you're age 70 and getting big jumps in the Social Security payment. So in other words, make sure you take it at full retirement age or earlier. Some spouses also combine the spousal benefit with their own primary insurance amount, and knowing when to take which one at what time is really important. And you probably know this, but I need to say it anyway. The spousal benefit does not kick in until the primary insured files his or her benefit. Then the spouse can file her or his benefit. These are just a few considerations. I have a video on the Social Security spousal benefit. At the end of this video, I'll put a link to that video so that you can go right into it if that's of interest to you. If you like this video and you'd like to see more of me, please make sure you click subscribe and turn on notifications so that you get alerted the next time I post a video. I post at least 2 times, sometimes even 3 times a week. This is Jeff Schmidt. Thanks for watching.